Welcome. In this video, can XCN coin 43x increase come in one go? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
The presence of a resistance zone just above the price represents a highly important structure in technical analysis. Such resistance zones indicate the likelihood that investors in the market may be inclined to sell at certain price levels, both psychologically and technically. A resistance zone essentially shows an area where the market has previously pulled back after reaching that level, where sellers have concentrated and where buyers have weakened. For this reason, the breaking of resistance zones signals not only a technical breakout, but also a significant psychological shift. If the price manages to move above this resistance level, it often creates the potential for a rapid and strong upward attack. A resistance zone is generally derived from past price movements, levels that have been tested before but not surpassed, or areas where the market has moved sideways for an extended period, form the basis of such resistance zones. These are the areas where a significant number of market participants have decided to sell. Therefore, when the price reaches these levels, the upward momentum may weaken due to increased supply. However, if buyers create enough demand to overcome the selling pressure at this level and the resistance zone is broken to the upside with increased volume, this is considered a breakout in technical terms and opens the way for the price to attack toward new highs. In this context, the current resistance zone just above the price represents a potential threshold. If the price moves above this zone, many investors will perceive it as a signal for a new wave of upward movement. Especially during resistance breakouts, increasing trading volume contributes to making this rise stronger and more sustainable. This is because such breakouts tend to attract not only short-term traders, but also medium and long-term investors into the market. After breaking through the resistance zone, this level can become a support zone. In other words, this previously impenetrable area can now serve as a floor that holds the price during pullbacks. The price consolidating just below the resistance zone is also an important indicator. It may suggest that accumulation is occurring in the market and that buyers are gathering strength to break through the level. During this process, price compression, decreasing volatility, and reduced volume are common. However, this calmness often precedes a major move. Once the resistance zone is broken, investors who entered during the accumulation period can exit with profit, while latecomers start buying to join the price movement. This further drives the price upward. In some cases, after breaking a resistance zone, the price pulls back to retest this level. This is known in technical analysis as a retest and is seen as a sign of a healthy uptrend. During this retest, if the price bounces back upward after testing what was previously resistance, this level has now become a strong support, meaning the market has accepted the level and the probability of the uptrend continuing has increased. Such price behaviors are closely monitored and evaluated by technical analysts. Another key factor in resistance breakouts is volume. If the price breaks the resistance zone on low volume, the sustainability of the breakout can be questioned. However, a breakout accompanied by high volume indicates that the market has shifted direction strongly and that new buyers have entered. In this case, the price is more likely to attack toward new targets. Volume-supported breakouts show that a large portion of market participants support the move and that the trend reversal is more reliable. A price-breaking resistance zone to the upside often signals the start of a new trend. Such breakouts are key signals of trend reversals. In markets that have been trending downward for a long time, resistance breakouts indicate that investors are beginning to believe the direction has changed. This strengthens the possibility of the price moving toward new highs. If the breakout is also supported by a chart pattern, such as a cut pattern or an inverse head and shoulders pattern, the technical targets become even clearer. For investors, resistance breakouts are among the clearest buying opportunities. This is because prices often show a strong and short-term rally after such breakouts. This rally can be triggered not only by technical traders, but also by algorithmic trading systems. As automated systems kick in, volume rises and the price can move upward much faster. This further strengthens the attack move. How the price behaves after the breakout is critical in determining investor strategies. For example, some investors enter positions immediately after the breakout, while others prefer to wait for the retest. These preferences vary depending on risk appetite and strategy. In either case, the important factor is the price's decisiveness after surpassing the resistance zone. This decisiveness reflects the strength and sustainability of the trend. In conclusion, the breaking of a resistance zone just above the price holds great importance in technical analysis. Such a breakout indicates that market perception is beginning to shift and that a new upward trend may be starting. If the price moves above this level, investor confidence grows, volume increases, technical patterns are supported, and the price can quickly launch an upward attack. This attack is not only a technical move, but also a psychologically and strategically strong price action. Therefore, resistance zones should be monitored closely in investment decisions, and breakouts should be analyzed correctly. The opportunities that structures present from a technical standpoint can provide significant profits for investors and can offer some of the earliest signals of directional changes in the market. But we can't make an analysis decision based solely on resistance. So let's take a look at the other metrics as well. Stay tuned.
The Bollinger Band is a widely used tool in technical analysis that allows us to visually analyze the volatility of price movements. This band typically consists of 3 lines. The middle line is the simple moving average, or SMA, of a specific period, for example, a 20-day SMA. The upper and lower bands are drawn a certain number of standard deviations above and below this average. This structure enables us to track the current level of market volatility and identify potential breakouts, expansions, or contractions. Now, as you mentioned, if there is a contraction in the Bollinger Band, this is actually quite noteworthy and can be a potential signal of a significant upcoming price movement. In technical analysis, this situation is often referred to as the contraction-expansion cycle. Let's explain this in more detail. A contraction in the Bollinger Band indicates that market participants are taking on less risk or that prices are moving within a narrow range with lower trading volume. This situation generally signals a decision point. As price movement decreases, the bands narrow, and among investors, it creates an atmosphere of calm before the storm. Technical analysts pay close attention to these contractions because the expansion phase that follows often greatly increases the likelihood of a strong directional breakout. From a market psychology perspective, this contraction period is both a patience test and an opportunity phase for investors. This is because most investors avoid opening positions during tight ranges. In fact, many stay away from the market altogether during this stage. However, truly successful technical analysts are those who chase the breakouts that disrupt this silence. For them, a contraction in the Bollinger Band is a phase in which the market is quiet on the surface, but internally preparing for a big move. From a more technical standpoint, there are also ways to measure contractions in the Bollinger Band. For example, the bandwidth indicator shows how much the distance between the upper and lower bands has narrowed. When this indicator drops below a certain threshold, it signals that the price is very close to making a move. As the bandwidth narrows, investors become more cautious and seek confirmation signals before taking positions. Typically, after such contractions, the price will either break out or create a fake out to trap investors. This is why tracking volume, candlestick patterns, and additional indicators such as RSI is important. Additionally, when the price remains within a narrow band, it often bounces down from the upper band or bounces up from the lower band. This provides short-term traders with good buy-sell opportunities. However, these opportunities are not permanent because at some point the contraction will end and the price will break sharply in one direction. At that breakout moment, breakout strategies usually come into play. In other words, investors see the breakout and, with the accompanying volume, open their positions. If the price strongly breaks above the upper band and this is accompanied by rising volume, a powerful upward rally can begin. Conversely, if the lower band is strongly broken and the volume supports it, a sharp downward movement may occur. So, if there is a contraction in the Bollinger Band and the price is still moving within the bands, this suggests that the price is ready for a breakout. This is especially common in cryptocurrencies because the crypto market by nature tends to be far more volatile and prone to sudden reactions. A contraction followed by a price breakout can sometimes result in sharp increases of 20%, 30%, or more. Of course, another factor to remember is that such moves are not only driven by technical factors, but can also be influenced by news events. Positive news can turn this contraction into an upward breakout, while negative news can turn it into a sharp downward sell-off. Another important point is not to make emotional decisions during this contraction period, because the prolonged lack of price movement can cause some investors to feel bored or impatient. Acting on these emotions can lead to entering positions too early, getting stopped out before the breakout, or missing the opportunity altogether. Therefore, the healthiest approach during a Bollinger Band contraction is to wait for the breakout and the volume confirmation, then enter the position once the direction is clearly confirmed. This way, risk management can be handled more effectively and the potential profit can be stronger.
The presence of an ascending channel formation is generally considered in technical analysis to be an important structure indicating that a gradual and healthy uptrend is forming in the market. Such formations help investors understand both short-term fluctuations and long-term price directions. In particular, when the price moves within this channel, it shows that there is a certain psychological balance and rhythm among market participants. The price moving toward the upper band of the ascending channel often suggests that buyers are gaining strength in the market, demand is increasing, and upward momentum may have been captured. Now imagine this. We have a clearly defined ascending channel, and the price has been slowly gliding upward from the channel's lower band. Each time the lower band has been tested, it has acted as a strong support area. Investors have taken positions there, believing the price would not fall further. Likewise, the channel's upper band has acted as a strong resistance zone. When the price reached this area, some profit-taking occurred, but the trend structure remained intact, creating new buying opportunities. This structure reveals that the price is progressing upward in a regular and predictable manner with fluctuations. And now, the price is approaching the upper band of this channel. This is not an ordinary technical signal. It should be considered a highly strategic and noteworthy development. The upper band of the channel may act as a resistance zone in technical terms. However, breaking above this zone could mean that all previous resistance levels lose their psychological effect. If the price surpasses the upper boundary of the ascending channel, it will have moved beyond the structure that has so far limited past price behavior. This signals the beginning of a new price discovery process in the market. If investors support this breakout with strong volume and there is technical confirmation, the price could potentially enter into a free rally. At this point, a massive upward potential, such as 43x, could become a realistic topic of discussion. Think of it this way. This 43x potential, if supported not only by technical analysis but also by investor psychology and supply-demand dynamics, becomes a scenario with a serious chance of coming true. Such a breakout creates a fear of missing out perception in the eyes of investors. This can lead to a sudden surge in demand, especially if the price has been stuck within the channel for a long time in the past and this channel has been followed in a technically stable way. The breakout moment attracts the attention of many algorithmic trading systems and manual investors. In other words, this is not only a technical breakout but also a psychological inflection point. A 43x rally scenario may seem like a far-fetched target in the imagination of most investors, but technically, setting such a target is often based on the ratio between historical lows and highs. For example, if the price has recovered from very low levels in the past, moved steadily within the channel, and is now approaching the upper boundary of that channel, this shows the depth and momentum of the formation. If this channel is broken, in technical analysis, the size of the rally is often calculated by using the width of the channel as a multiplier. But here, we are talking about something much bigger, a 43x jump. So, why 43x? If this number is not a random figure, it is probably related to the potential peak level measured from the channel's low point. In other words, if the starting price within the channel was as low as 0.001, the potential upper target might represent a level like 0.043. This would mean that the price, which has moved consistently within the channel structure, could climb 43 times higher than its current level if the structure breaks upward. Such potential projections may be especially valid for low market cap, highly volatile assets. In the cryptocurrency markets, scenarios like this are not uncommon. For investors aware of this potential, this stage is extremely critical. In such large breakout scenarios, there are two important phases. The first is the breakout moment. The second is the post-breakout confirmation and continuation. Simply touching the upper band or briefly breaking it may not be enough. To understand whether the breakout is real, closes above this level supported by volume are needed, along with the price starting to make consistent new highs outside the formation. If these confirmations occur, then the door to a potential 43x rally truly opens. However, another important point to note here is risk management. While such large potentials are exciting, they can make investors prone to emotional decision-making. Therefore, position sizing, stop-loss levels, and take-profit strategies should be planned in advance. After the channel is broken and the price starts expanding upward, it often comes with high volatility.
This can bring both large gains and sudden pullbacks. Therefore, the investor must remain calm during this process and analyze whether the technical structure is intact. On the other hand, such major breakout scenarios not only offer a short-term profit opportunity, but may also signal the beginning of a long-term trend. Once the price moves outside the channel, it may be signaling a transition to an entirely different trend structure. At this point, it is important for investors to correctly analyze the characteristics of the new trend and, if necessary, update their strategies. The dynamics of this new trend may differ from those within the channel. External factors such as increased momentum, news flow, and social media interest can also affect the strength of the new trend. One important advantage for investors who believe that a 43x rise is possible after an ascending channel breakout is that in such large moves, there are no historical resistance levels to hold the price back, meaning the price has effectively moved into free territory. This shows that the technical upper limit to where the price can go is difficult to predict, meaning it has entered a discovery zone. At this stage, investors should not only follow technical analysis, but also market sentiment, news, and non-fundamental variables such as the effects of social media.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.